What's up, guys? Welcome to the first video of my financial education series. I want to make this series because I don't think finance in general is talked about enough in schools, and I think I think everyone should know about it. So the first video I want to make is going over just basic stocks. So essentially, what a stock is you're buying into or you're buying part of a company. So let's say you have Apple. Let's say you have Apple and they're selling 100 shares of the company. So essentially, a majority of these shares will probably be owned by the CEO, the founder, and all the high execs. So let's say let's say 60 of the shares are owned by the execs and stuff, which leaves 40 shares to the public market. Now, obviously, a company like Apple is going to have millions and millions of shares available to the public market, but just for simplicity's sake, we're just going to say there's 40 shares. Now, let's say each of these shares is worth $10 each. Okay, so you have 100 shares times $10, which gives a $1,000 valuation, right? 6,000, or sorry, $600. $600 by execs, and then you have $400 available to the public. Now, anyone can open up a brokerage account and buy however many shares they want, assuming that there's enough. So in this case, let's say a person wants to buy 5 shares of Apple. So they want to buy 5% of Apple. Obviously, again, in the real world, that's not how it's going to work because Apple's such a humongous company. Buying 5% of the companies is extremely basically impossible. But just for this example, let's say a person wants to buy 5 shares of the company. So there's 40 shares available to the public, and a person wants to buy 5 shares. So the person would have to spend $50, and in turn, they get 5 shares. Now, essentially, in the example, they own 5% of Apple. So as Apple increases their revenue, as more people buy into the shares, the stock price per share will increase. So let's say, so the share price equals $10. Let's say after 2 years, the share price goes up to $15. So now, essentially how this works is they purchase the shares for $50. Let's give this a year. Let's say year one. Year one, they purchase the share for $50. They hold the stock, or they hold their positions. They hold their 5 shares for how long do we say? Let's say they hold it for 2 years. So year one, year two, year three. We're not going to count year one as the first year because year two and year three. But so they hold it. This is their original investment right here, the $50. After 2 years, the 5 shares is now worth $15 because Apple's Apple's is making more revenue, more people buying the shares, more people buying the products. They're expanding their company, so the company's becoming more valuable. So the price per share is going to increase over time. So the original investment of 5 shares at $50 after 2 years will turn into 5 times whatever the current share price is. So if the share price is, we said, $15, 5 shares is going to turn into, what's 5 times 15? $75. And that's going to be year 3, after 2 years. So, by putting up $50 original investment equals $50. After 2 years, investment, after 2 years, the original investment is now $75. So after those 2 years, by investing the $50 originally, you take the current share price, assuming you sell the stock, and we'll talk about that next, but you take the current share price and you minus it by the original invest, or not the current share price, the current market price of your shares. You minus it by 50, so equals that this person who bought 5 shares of Apple, trading at $10 each, in year 1, has now made $25 in the span of 2 years by doing absolutely nothing. They just bought the stock for $5 a share, or sorry, $10 a share. They bought 5 shares, so $50 original investment, and then by just holding on to that stock, they made $25 profit without even touching it in the past 2 years. So $25 in 2 years without doing anything. Now to get into the more technicalities of the stocks, like I said, you have to buy it or sell the stock. So in order to buy a stock, someone needs to be selling you the stock. So in this case, let's say Apple is the one who's distributing the stocks. You would usually go to a brokerage, but just for simplicity's sake, Apple selling 1 share stock at $10. And we have a person, let's call him John. He wants to buy 1 share at market price $10. So in order for John to buy the share, in this case it's Apple, but someone has to be selling you the share. It's not, you can't just make up shares. You can't just buy a share out of thin air. So in order to buy a share, it's like when you go to the supermarket and you buy eggs. The supermarket is selling you the eggs. So in this case, Apple is selling John 1 share, and John is buying it from Apple. Obviously, how it works in the banks and the big whales, brokerages and all that. Obviously, you're not just buying 1 share, and you pool together multiple buyers and sellers to complete an order. But I'll go into that in another video. But essentially, when you want to buy a share, someone has to be selling you that share, which is what the brokerages are for. And also vice versa, you could short a stock, sell a stock. That's another video. But I guess I could talk about that now. So when you're selling a stock, someone is buying it from you. So let's say John wants to sell now. Selling a stock is much more risky than buying a stock, which I would advise against unless you know exactly what you're doing. But so John, he wants to sell 1 share at $10. This means John thinks the share price of Apple is going to go down. So in order for John to sell it to, let's say Frank has to buy it from him. So he has to buy it from John at market price. So in order for John to make a profit off of this, the $10 share price has to go to less than the original investment. So it could go anything less than $10 essentially. So let's say his original investment $10. Let's say the share price of Apple goes down to $7. John made $3 profit by selling his stock to someone who's buying it. So essentially, John, by when you sell a stock or short a stock, you make profit off of the difference between what you buy it at and then, or sorry, what you sell it at, and then what you then buy it at back later. So essentially, buying and selling stocks is very simple. It's literally just a transaction. It's literally just a transaction between two parties, like anything in the financial world. So you need two parties in order to buy or sell a stock. In order to buy, there needs to be a seller selling it to you. And in order to sell a stock, there needs to be someone buying it from you. Now, if you buy market price, whatever you sell the stock at, is going to be the profit. And if you sell it at market price, whatever you buy it back at later, which might be a little confusing now, let me know if you guys have questions on that. But whatever you buy it back at later, the difference between what you sell it at and what you buy it at is going to be your profit. But essentially, it's very simple. I mean, there's a lot more that goes into it when you pick your investments, but essentially you pick a company or commodity or whatever you want. So let's go with Amazon. Amazon, you pick a company. If you think the company's going to do good, you put money in. You put, let's say, $100, buy X amount of shares at, let's say, $5 a share. So how many shares can you buy? 100 divided by 5. You could buy 20 shares. And now you hold it over a certain period of time, X time. You hold it over a certain period of time, and over that time, Amazon is hopefully going to become more valuable, and more people are going to be buying shares, which increases the share price. So you buy it at 5 and you sell it at 10 over, let's say, 3 years. So how much profit do you make if you invest $100 at $5 a share and then sell it in 3 years at $10 a share? So here's the answer, guys. So $100 a share divided by $5 share price equals, you buy 20 shares, original investment. And 3 years later, what's the share price at? $10. So 3 years later, 20 shares is now worth what? The shares? It's worth $10 a share. 10 times 20 is what? $200. So how much money did you make throughout the 3 years? Wait, I just confused myself. Shares $10. Yeah, okay. So yeah. So how much money did you make? Your original investment was $100. Changes to $200. So you basically doubled your money within 3 years. Obviously, this is not likely to happen. It can happen, but it's very unlikely to happen that you double your money in 3 years. But just by doing nothing, by picking a good investment, he took his money, original investment of 100, and turned it to 200 by doing absolutely nothing. So instead of spending money on something like, I don't know, something useless, he put his money into assets, and now after 3 years, he has double his money. Now you might be saying 100, 200, that's $100 in 3 years is nothing. But guys, imagine you took $5,000 and turned it to $10,000 without doing anything. I mean, stocks are one of the best ways to preserve your wealth and create wealth. So I don't think this is taught enough in schools, if it's even taught at all. But I think everyone should know about how stocks work and what they are. So, if you guys have any questions, um, leave it in the comments or DM me or whatever, and I'll try to make another video on it. But I hope that helped you guys understand stocks and how it can make you. Obviously, it's not going to make you rich in 5 days, but it's stocks are a very good way to create long-term wealth and keep yourself financially stable, assuming you invest correctly. And I'll make another video about how you should invest and what to avoid and stuff. But yeah, thank you guys for watching. If you have any questions or comments, please leave them in the comments or DM me.